We've looked at a lot of opportunities today and investment opportunities and way to tap into themes and everything. Arguably, it starts with us, though. It starts with our attitude to being good investors. If we aren't good investors, those opportunities can stay there and we'll never touch them. Or we won't know how to buy, we won't know when to sell. We'll not really have the attitude to be really good investors. So full disclosure, I'm going to be talking about some of the biases that I feel like I've fallen into over the past year and some of the ways that we can maybe address those and overcome them in the new tax year. So a little bit of a... Yeah, won't actually be talking about investments, but we always have to put these things up. Making decisions is what investors do. That's what we're doing all the time. But let's think about in wider life. That's all we're doing all the time. Some investments or some decisions are more important than others. Some are just pretty rapid decisions that we make all the time. When we're thinking about making decisions, actually, when we take the psychology of it, we start to think about two systems that we have in our brain. We have system 1 and system 2. System 1 is the one that some people might call your Homer Simpson brain. So in your Homer Simpson brain, you're thinking instinctive, quick reactions. If you hear a car horn, you're going to use your Homer Simpson brain to get out of the way. System 2, people sometimes call your Spock brain. You're more measured, more thoughtful, more deliberate, active decision-making brain. A good way to actually just have an example of the two is to think of your phone number. You could probably even see it in front of your eyes. That's your System 1 brain working. Can you tell me your phone number backwards? That's your System 2 brain kicking in. So the System 2 is the more deliberate one. Now, I don't need to be a genius to tell you which one you need to be using for your investments, but I think if we're all honest with ourselves, we know which one we actually use. It's about harnessing that, and it's about seeing how simple ways that we can tell ourselves, actually, I'm using the wrong one, let's fix it. It all really comes from, if you haven't read anything by Daniel Kahneman, I would suggest go out and do it today. Thinking fast and slow is really what got him his Nobel Prize in the behavioral economics field. Thinking about making decisions under pressure. It is an extremely interesting book. I would probably get the Spark Notes on it. It's very dense, but it's definitely worth a read. A good example here is what I have up here. This is something that we tend to do all the time. We take simple inferences and simple information, and we just make a quick decision. Because as humans, we want something that's quick, easy, convenient, and we want the shortcut. We never really want to think about things too much. We want the stock that rises tomorrow. We don't want to put the research into buying a boring FTSE 100 company that dividend grows over 10 years. We don't want that. We want the AIM stock that makes us a millionaire tomorrow. So Steve, you've all read this. Steve has the attributes of being quite a meek and tidy soul. He likes order and structure. So think to yourself, which one's he going to be? Is he going to be a librarian or a farmer? This actually appears in Kahneman's book. Now, you all know which one you're probably going to go for. You all know what reasons probably why you shouldn't go for that. I would suggest that initially, if we weren't in a behavioral economics talk, we would be going for librarian. Seems reasonable enough. We've got the characteristics. We know how to spot it. We know, literally, we know the quick and easy way to convert meek and tidy soul and detail into someone who's a librarian. Now, the first remedy that we have whenever we talk about our System 1 and System 2 brains is to think about, okay, what is the wider data set? What information am I being presented, and is that enough? If we take the wider data set, we would know that in America, farmers outnumber librarians by 20 to 1. A simple statistic shows us that he's more likely to be a farmer. It doesn't really matter about his attitude. So the first thing that I've kind of tried to teach myself is to widen the data set. We're so primed to making decisions just like that, to look on message boards, to hear tips on Twitter and everything like that. What is the data set we're working with, and is it enough? So that would be my first point. So we're going to look at 5 behavioral biases, really, that certainly affect me, I would imagine affect all of you as well. I just want to give you a little rundown of them and specific ways that we can overcome them, or at least react to them in the new tax year. First one being confirmation bias. I love this. I love looking at confirmation bias because I know that we all do it. I remember at university researching a topic and having a firm idea and only researching the point that supported my point. If I was trying to be a little bit even more cute about it, I would read and quote the book that my lecturer had written. Seemed to get the better marks that way, I don't know why. But confirmation bias is we are twice as likely to look at information and agree with it if we already had that belief in the first place. A good example is in the 2016 referendum. If you look at people's Facebook feeds, Cambridge Analytica did a little work on this and found that during the referendum and the run-up to it, people were more likely to hide or unfollow or unsubscribe to information or people on their feeds if they didn't agree with their already existing points of view. So what that means is that you end up with this echo chamber of beliefs that are only reinforced. So then you get these polemic viewpoints, and then you start to get argumentative, and that's what breeds far left and far right thinking. We do this all the time. Think about if a child asks you a question, if they're arguing with their friend and the child asks you a question, they will never say, okay, well, here are the 2 points of view, which one's right? The child will say, aren't I right? Isn't this the way that we should be looking at that? And I wonder how many of us are Googling these types of things or only exploring one side of the argument. This leads quite readily leads into availability bias, using information that's just at hand to make decisions. If you're in an argument and your system one brain kicks in and you have to think of a statistic to support yourself, chances are you're thinking of, obviously, the one that gives you the most leverage in the argument. This is why campaigns are based on simple figures and simple facts that you can really just rely on when you're in an argument very, very quickly. If you think about numbers on the side of a bus, for example, I think that happened a few years ago. So a good way around that is to argue the opposite point of view. It's very easy to say that. Of course we should be arguing the opposite point of view. If, like me, you're living with someone who likes to do that already, it becomes even easier. However, we need to be thinking that there are more points of view than ours. What I've tried to force myself in my own investments to do over the past year is to actively argue the other point of view, actively argue the opposite. Sometimes I've found out that actually the opposite was better for me. Sometimes I found out that it wasn't. But actually, having done both made me feel so much more justified when it came to actually making the decision. I felt like I'd actually done a bit of research. Giant redwoods are extremely important in investing. I'm going to tell you why. Everyone knows the sequoia tree or the giant redwood's tallest redwood the tallest tree in the world. What I would like for you to just think about in your head, I'm not going to ask for anyone participation just yet. What's the greatest height of a giant redwood? What do you think? Now, unless you're a keen arborist, I'm not expecting great answers here. Some of you might be. Please don't tell the person beside you. So have a number in your head, even if it's just a wild guess. I'd really love you to have a number in your head right now. What if I told you that whenever I ask this normally to groups, the average answer is 100 feet? Now, I'll allow you to change your answer. That's absolutely fine. I don't know why they say 100. 100 feels right. It feels big. It feels rounded. Doesn't feel like you're going to get chastised if you get it wrong. But I'll give you a chance. If you want to change your answer to round it down or to round it up, that's absolutely fine. So I should say at this point, I would actually quite like someone to answer in the audience. So I would like to ask one person. So if you just have an answer in your head, because I will ask someone. So I'm not going to go right to the front. I feel like people would be wanting that. Far back seems a bit for me, so I'm going to look in the middle somewhere. But of course, I'm not actually going to ask anyone. The point there is I want you to focus on how you felt when I might have asked you. I wonder, did you have a figure in your head, but you brought it down to 100 because it's actually better to fail with the crowd? You won't look silly if everyone else has guessed that. Or I want you to think about why you didn't change your number, why you were so headstrong. Now, unless you're an expert in these things, that's as much of a bias as well. Why did you think you were right when everyone else was wrong? It's funny how we think. This is an example of anchoring and framing. Anchoring to numbers that mean nothing and that we have no idea. I mean, this is completely fake. I've never asked this question before, so no one's ever said 100 feet. So why are we so drawn into numbers? It's because we need data. We want data and we seek out data. As I said, we want shortcuts, so often we will only take the first data point, but we do feel like we want data. When we get that first point, we relax. It's not always good for us, but it's what we do. Think about car negotiations if you're buying a new car. The first person that mentions a number in that conversation wins. Because as soon as there is a point, everything else, haggling around that, it will just haggle around that one number. That's why if you're the first person to mention the number, you're the person that sets the negotiation tone. That's the anchoring. The framing element is something that Alistair Munday from Investec is very good at speaking about, talking about that day that you specifically saw that company, or you saw that stock, or you saw that 40% rise or 40% fall. That day might be completely irrelevant in the life of that company, but it's the day that you saw that number. And actually, how many of us have sat on a company and thought, okay, well, it's 100 now. I'm only going to buy it when it's 90. No, 90 means nothing. But for us, it's a discount. I did that a long time ago with a few stocks, Fevertree being one of them. Didn't get in, never managed to get in. Because I was anchoring to the point where, okay, well, I know it's a good company, but I couldn't possibly pay today's price. I have to pay tomorrow's price, which would be lower. Tomorrow's price comes, well, I can't pay that. It's on its way down, I can't do that. So all of this can be answered, and really a lot of these things can be answered by fundamental bottom-up research. We anchor to numbers because they're there. Well, what if they're not there? What if we create those numbers? What if we rely on our own research? Or of those fund managers that we're invested in? What if we really know what they're doing behind the scenes, and we know that they're dealing with their biases and their teams are wide enough to be able to argue the point of valuation, rather than us seeing the share price on a Thursday and buying on a Friday? One thing, I'm a writer, of course, I'm contributing to the information overload. I like to think that I'm one of the good sources. But a very simple example is, you let a kid loose in the cereal aisle. They have no idea what they're doing. They will get so high on the thought of sugary snacks and sugary cereals that they probably won't pick anything. And what we tend to find is that when we do run these experiments with children, is that they're never actually that happy with what they end up with. And after all of this deliberation and all of these choices, they're never actually happy. Because once you make a choice, you rule out infinity, and we hate that. It gets into the sources that we're trusting whenever we're investing. I'm not going to say that you should have 10 sources that you should always trust. I'm not going to say that you should have 100 or only 5 bull managers that you should have and 5 bears. I'm not going to say that. There's no quantifiable evidence of that. But there is a difference between wisdom and knowledge. Of course, the simple definition is knowing that a tomato is a fruit. Wisdom is knowing not to put it in a fruit salad. But really, whenever we talk about knowledge and wisdom, we're talking about using our faculties to decipher which information is quality information. What is the source of this information? How have these people got that? In the end, it comes down to the underlying data. Can we get access to the underlying data? A lot of what I write is based on trends, based on figures that come out from the government, so ONS figures. It's very, very difficult to argue with a figure. You can put a slant on it, of course you can, but if you read something and you go back to the underlying data, you're never really going to go wrong. This is why opinion pieces are very, very, especially now when anyone with half a brain can write anything on the internet, it can be quite difficult to decipher that. And I think anyone who's a fan of the US version of The Office knows that Michael would say, Wikipedia is a fantastic tool because anyone around the world can write anything on any subject, and that's how you know you're getting quality. Yep, sorry, that went up too quickly. I know you've all thought of Pepsi anyway. But we, as humans, we prefer the comfortable. We're very, very skeptical of change. We're very, very skeptical of new things coming along. We don't want to buy into it. We actually get a bit of a kick about being skeptical and then being right when we're skeptical. Oh, that'll never catch on. And whenever it doesn't, I never trusted it anyway. How many of us have had that conversation around Bitcoin? Yeah, I never got in. That was absolutely, if it was the right call. Did I tell you I made the right call? We love that. We love that. Baader-Meinhof, as well as being a 1970s communist militarized group, as we all know, is also a phenomenon where it's probably easier to say if we say, if I say, imagine a red car. Isn't it amazing how many red cars there are on the road? Now, you might not have already been focusing on the red cars, but I tell you what, you will whenever you go home tonight. you'll be focusing on that. Baader-Meinhof is the phenomenon of noticing things that were already there, but attributing newness to them, or novelty, because of the fact that we noticed them. It's not really fair, and it's not fair on us, but it does happen. So it's about being exposed to these things. That's the issue. Colleague Tom Stevenson talked about home bias in reference to the UK market and how we probably over-index in our holdings of the UK market. I wonder how many of us would feel comfortable off the bat going home and rebalancing into a global portfolio of widely held stocks right after this. There's something within us that thinks, actually, I used to shop in Debenhams, so I'm actually quite comfortable holding that stock. It's undervalued, so I'm actually quite comfortable holding that. You could find the exact same attributes in another country, and you might not want to do that. So that's home bias. We need to start thinking broader than the UK. We also need to start thinking that just because we notice something doesn't mean it's new. It's amazing how many columns I read about this new investment idea that's been around for 50 years. That something doesn't quite add up, but because someone's noticed it, it kind of adds value for them. It feeds into two other ones. So the endowment effect, the feeling that because we own a stock, it's worth inherently more. Because I own it, yep, I'm willing. When the price goes down, I'm more than willing to add and to decrease my average, as it were. If you weren't in the stock, you'd be thinking, I'm not going anywhere near that. It also breeds into the IKEA effect. Just because I made the table, I think it's worth more. I'm certainly like that with my amazing coffee table at home. And this is why car boot sales can be such a minefield, because someone's trying to sell their old mirror for £1,200 whenever you can see it's really not worth that. They think it is, therefore in their mind, that's what they're selling it for. I wonder if we are doing that with our stocks. So really interesting, and one of my favorite things to talk about is nudge theory, and its opposite, sludge. So nudge is a really interesting phenomenon. Richard Thaler talked about it, really popularized it, being this way that we can influence people to do certain things, but we're not pushing them. We all know when we're being pushed. Advertising is a good example. We all know when we're being really pushed or pulled towards something. Nudge is a little bit more subtle. So think about what's happening in my house at the minute is that there's more fruit on the kitchen table and I can't find the chocolate biscuits anywhere. That's a nudge for me to go in the right direction. The chocolate biscuits are somewhere. I will find them. But it's not inherently coming out and saying you need to do this or you should be doing this. It's just to point us in the right direction. UK government is already doing it with things like the auto enrollment. Governments around the world are doing it with opting in and opting out of organ donation. So a lot of companies are turning to the fact that, okay, well, you're now opted in and you have to make an effort to opt out. We're lazy. We don't want to opt out. So this is why nudge theory is so important. The opposite is, it's a little bit controversial at the minute and has been over the past kind of 18 months, this sludge theory about maybe making decisions on behalf of some people that some people find unethical. GDPR is a big one. When you had to actively opt in, that's fine for your email traffic and subscriptions. Some companies out there were, once you had to opt in, we're having toggle buttons saying, here are 100 emails that you could possibly get from us. Please toggle them all to off if you would like to not receive them. It's a bit of an unethical nudge because no one's actually going to do that. Don't know. Everyone jokes about, there was a really interesting fact on page 19 of the Apple terms and conditions. I'm sure you all read it. It's never going to happen. So that's the theory. What I would say for us, though, the most important nudge that we can do for ourselves is to be regularly investing, is to set up monthly or regular savings plans. We know from history, and again, your biases will be working against this, but we know from history that those who save regularly into their investments do much better over the long term. When you're sitting in cash and you're trying to wait for the best time to get in, even if you were to get that, you would still not be racking up the dividends and still not be experiencing the growth that someone who's just trickling their money in over months and years will be getting. And I know that some of you are still reacting against that because that is the way bias works. We think that, no, I'm actually better than everyone else. American drivers, 77% of them think that they're better than average. Statistically impossible. But given a year later, they answered the exact same way. We know that this is how we're reacting. So what I would say is in terms of nudge, in terms of all of these, it's about self-awareness. your first step is not to try and tackle these biases. It's about self-awareness. It's about spotting whenever they crop up. For me, it means Post-its on the side of my monitor at work. It's about an investment checklist, 10 easy questions that I should be able to answer for every single investment I make. If I find myself deliberating and kind of thinking, well, this sort of answers question 5, it doesn't answer it. If you can have an honest conversation with yourself, or if you find that too difficult, if you can just set up the nudge and never actually have to deal with it, that's even better. I should mention, Amsterdam Schiphol Airport. Again, you've read the slide, to decrease the cleaning bills. They put this little sticker in, and it actually worked. Someone told me recently, rather disgustingly, that it is placed at an angle for fluid dynamics, but well, we'll move on swiftly. So we've talked about these biases and how they're at play, but really we need to be looking at how we solve them. I've said that self-awareness is the first battle. Self-awareness and empathy are really, really important, and they're not words that we tend to associate with investing, especially when we think about stocks as opposed to funds. It's meant to be rapid fire. It's meant to be quick system one thinking in our heads. It should be that slow, deliberate process, and if you're reacting to the 40% drop on the day, that is system one. If it was something that didn't even come across your Bloomberg terminal or your radar, and you're only looking at it because the price has gone down, you're system one thinking. If it's been on a watch list for a while and you've been deliberating and you think that you can pick up a company that you love because you've done the research and now it's now cheaper, hey, fantastic. But if not, I wonder if you're fooling yourself into thinking that it's a good company at a cheap price. So as I said, a few things we've mentioned here. Regular investing, so important. A clear, defined investment process as well. If you can find an investment manager or a fund manager out there who will never, ever deviate from being a value manager or a growth and quality manager or sticking through thick and thin times, arguably that's better than their returns in the short term. If they can demonstrate to you, or you can demonstrate to yourself, that you will never waver from your guiding principles. And there's many ways to skin a cat. You could be a deep value investor and do very well. You could be a quality growth like Terry Smith or Nick Train and do very well. But the important thing here is that if you are going to invest regularly into someone's fund, that they never ever change tack. Good way to keep up to date with that is just to read what they're doing. Good investment managers will put out monthly or quarterly what their theses are, even when they're bad, and they'll justify them. Pre-mortem thinking, that's something I've been trying to do this year as well, is thinking about, okay, if I buy this stock tomorrow and it tanks, if it goes down 50%, what will my action then be? It's no good doing it when it happens because my heart will be going and I'll be falling to all sorts of biases. I'll be thinking, great, it's cheap now, I should be buying more, or I need to save face. I work in investment, I can't possibly sell now. I need to make a growth story about a massive turnaround story out of this. Thinking about that before it happens gives us a tremendous ability to actually act that way if it were to happen. Someone said to me recently, it's a really good idea to think, what if you found out tomorrow Warren Buffett owned a short in the company that you've just bought? Well, he doesn't really do shorts, but what if he came out and said, I'm definitely not investing in this company? Would that change what you're thinking? So pre-mortem thinking, that's what I'm doing. Peter Lynch, famous Fidelity investment manager, said, when you constantly rebalance, you're watering the weeds and you're picking the flowers. If your investments are set up for the long term, and if you have followed these ways to set up your portfolio so you never actually have to touch it, checking in every 6 months or a year is absolutely fine if you just want to rebalance those assets just to get your risk back in order to suit what you're investing for. But doing it every day, which is possible through everything that we have in our pocket, all these apps and real-time market tickers, if you're doing it every second or you're changing every day, you're not, on a practical level, you're not allowing any dividends to pick up. You're certainly not allowing any growth, and you're probably paying over the odds in fees and trading fees anyway. So once a year, 6 months is more than enough. When you log in, you increase the chances of you making a mistake. Look at it like that. If you don't log in and you just let the market ride out, hey, you could be in a better position, or at least equal. We've touched on a few of these. I think one that I'd really like to focus on is Annie Duke's 10-10-10 rule. That's something that's been quite important to me, just to really slow things down when we're making decisions under pressure. Will this decision matter in 10 minutes, 10 days, or 10 months? You can change it to 10 days, 10 months, 10 years. But when will it matter within those time frames? Put yourself in those positions, and this is the beauty of encompassing your whole life as well. You're not actually thinking as an investment manager. You might be thinking of your personal circumstances in those 10 months, 10 years, 10 days, 10 months, 10 years, 10 hours, I don't know, 10 minutes. And you might think, okay, well, do I need this money in 10 months? Do I need it in 10 years? Can I afford for something to have a blip and for me to feel a little bit uncomfortable in the short term, but then trust in the equity markets to do what they've always done through history? The 10-10-10 rule, that's something that I've been really, really trying to do for myself over this year. We have discussed some ways that we can overcome these biases, but realistically, if nothing else, I would like us all to take away from today that simply recognizing them when they come up, these biases or heuristics or whatever we want to call them, simply recognize them when they come up is half the battle. If you can be that self-aware that when the heart starts pumping and a stock falls or you get a really good idea about something, that you can stop and say, is this for real? Which one of my biases is showing up? You're already half the way there. And the last thing, Terry Smith and Warren Buffett are famous for saying, don't just do something, sit there. Because we know that time in the market works. We've got 30 years of someone investing £60,000, and we can see that Steady Eddie, the person who's drip feeding the money, he probably hasn't even looked at his account for 30 years, has beaten the person who has been able to time the market exactly right, because they've been just hoarding cash until they get the right price. And they've done obviously better than the person who's been very, very unlucky and bought at the top throughout those 30 years. It's about recognizing that we have these biases, meeting them head on, having a few tips, a few Post-its. I think basically my whole talk is about Post-its. If you can have Post-its everywhere, reminding you that you're not as good as you think. It's a little bit of a hit for the ego in the short term, but it does pay dividends. If we can do those things and then start to think about, okay, well, how am I going to manage this right now? Do I have the capabilities to actually do this myself? Or realistically, is it better if a fund manager or someone outside of my control runs this for me? Because they have the time and the access and the analyst teams to do so. So not an exhaustive list, and heuristics are a fantastic thing. I would urge you to read up on them, or at least watch Freakonomics. It's a fantastic film. It's about just knowing that they're out there. And it's about meeting them head on. Thanks very much for listening there. A little bit of a whistle-stop tour.